Guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. And this week's topic, guys, is bar by bar analysis. You ever get into a trade and within like a minute or so, you're like, man, this thing isn't going to work, but you stay in it anyway and still stop out? Why? Right? So today we're going to talk about that topic, how you can, after you get into a trade, how you can mitigate the potential loss on it. Sure, we can't be 100% with this, meaning sometimes you will take a full loss, but what if we could mitigate some of those losses to where maybe you take a half of a loss or be able to get out at break even because you're reading the bars accurately. You're looking, saying, wow, that's a topping tail, or that's a volume spike, or that's relative strength to the market, or an engulfing bar, all those types of things. That would be very beneficial to your bottom line as a trader. Well, that's what we're going to talk about today, okay? It's a very, very powerful topic because many times a trader will get into a trade and they're like, it doesn't look good, but I'm just going to ride it anyway. Well, now you'll have much more concrete, specific information for when you should stay into a trade and when you should get out of a trade. And trust me, when you learn this to a high level, it will work 80 to 90% of the time, and it will save you a lot of stop outs, okay? So, as always, guys, if you like this video, please click the like button, hammer that subscribe button, and don't forget those click notifications. Guys, this is an awesome channel. There's a lot of great content on here. We got to get the subscriber count up. We got to get those likes up. We got to do all that good stuff, all right? So, I'm Jared Wesley of Live Traders. Let's get to it. All right. This week's lecture topic is stick a fork in it. That trade is done. So over the past, I don't know, a couple weeks, 3 weeks, we've talked a lot about the choppiness of the markets, as well as things that you can look for to know when a trade might not work. In fact, I think it was last week we had an exact lecture on what I look for when trades don't work. So some of you immediately might see this title and go, stick a fork in it, that trade is done. Go, that's the same as last week. It's not. Today, basically, even though the title is a little different, we're basically going to talk about bar by bar analysis. Not bar by bar trade management per se, but bar by bar analysis. And this is a topic that we don't really talk about that much, to be honest with you. So I think the current environment makes this topic much more appropriate because we're seeing a lot of stocks that we get into that are just really range bound and they're back and forth, choppy, et cetera, and so forth. So I thought that last week's topic was appropriate for the current environment, and this week's topic might even be more appropriate than last week's topic. But before we do any of that, before we talk about bar by bar analysis, we first must talk about when will the insanity stop? When will it stop? Got a couple good ones for you this week. Maybe throw you a little bit of a curveball this week. So the first one, all right, boom. We have somebody that says $800 to $13,000 for March, 1,400% gain. First month day trading options. Risked a whole lot, but made a lot. I only recommend doing this if you're willing to lose the little bit that you're starting with. My goal is to hit 25,000 by the end of April. Oh boy. Oh boy. First month trading options, it says day trading options, made 1,400%. I would call that extremely, incredibly risky. In fact, this person admits it was risky. Risked a whole lot, but made a lot. That's never a good statement. I risked a whole lot, but I made a lot. I think people do this all the time. I got an email from somebody. This is a true story. I got an email from somebody a few days back. Like, Jared, I have $10,000, and I really need to turn this into a lot of money quickly. And I said to this person, look, I'm not the person to ask. I said, you should put your money in a total market fund, VTI, Vanguard fund, something like that, and just do it the slow way because that's the most reliable way to do it. If you're really jonesing to take something, buy Bitcoin or Tesla. And I was joking, even though those are two risky things that have gone up. Sure enough, like 3 days later, I get an email back from this guy. Thank you so much for the recommendation, literally, recommendation to buy Bitcoin. I bought it and made $3,000. I made, 30% overnight or something like that. And I'm like, Nowhere in my email did I recommend that you buy Bitcoin. People, they do some interesting stuff. You know, you can only lead a horse to water. You know what I mean? So we start with this: when will the insanity stop? Because it ties into the next when will the insanity stop that you'll have to wait till next week to see. I'm kidding. We'll do it today. So I have two of them today. So this person obviously is being very, very risky to take $800 into $13,000 for March. But this is the exception to the rule, right? This is not the rule. This is the exception to the rule. The next slide is what normally happens to people that do silly, crazy shit like this. Okay? Bam. I blew up my account in 3 days. That's far more common than somebody taking $800 into $1,300. Okay? And the reason I pulled this one out is because it appears, and I don't know this person, it appears this person had the right mentality when they started. All right? It does. It appears. So today, it said I started a few months ago reading books, watching YouTube, lurking around, blah, blah, blah. I paper traded, all that stuff. So far you're thinking, okay, that sounds reasonable, right? I'm lurking around trying to gain information. I paper traded. Like, so far you're like, all right, that's not bad. That's not bad. Okay. Day one, I ended down $4,000. Idiotic, but I told myself it was my first day, nerves, and I learned a valuable lesson. Day two, I was up 800, feeling great. My goal has always been to hit 1% to 2% profit. Well, that's pretty unrealistic for a new trader. But then it gets into this stuff. Early on, I took a huge hit. A stock plummeted on me quickly, and I fell below 25K. This made me nervous, but I tried to stay calm and just get myself back above 25K so I could live to trade another day. Well, you know the rest. Uh-oh, right? So I guess I'm posting this as a warning for other new traders here because I was so certain this wouldn't happen to me. I read a ton, I watched a ton, I practiced a ton. I used money that I didn't think would hurt to miss. So it does appear this person generally came in with the right idea. So why am I showing you this other than it's insane that you blow up your account in 3 days? That's why you're on the segment. It's because this can happen to anyone. Right? Just because you think something, and this is why maybe it's a good idea for newer traders not to stock their account with a huge amount of money, because if it's in there, it's at risk to a new trader. Okay? But blowing up an account in 3 days is that's just unbelievable. I don't know that this person went to zero, but they said they basically blew up their account. Pretty crazy. I'm showing you these back to back because in one, I guarantee you people out there watching this video will look at the first one and go, wow, $800 into $13,000. Sign me up. Show me how you did it. I want to do the same thing. That's just dumb luck. And then the next slide is I blew up my account in 3 days. That's what's going to happen to most people that try these shenanigans and this horseshit. So what's it bring us back to as we talk about every single week? Respect the market. Respect money management. Respect this business. If you don't, you're not going to have much money left to trade with, if anything. Okay? So respect it. All right? Absolutely respect it. You are not better than the market. You're not as good as you think you are. I don't care if you went to MIT or Harvard or wherever. You're not that good. Okay, idiot? Yeah, I'm talking to all you. Okay, idiot? You're not that good. Respect it. Have good money management. Risk $5 a trade, $10 a trade, or else you might blow up your account. All right. Let's get to the good stuff. So, bar by bar analysis. All right. So last week we talked about a couple things, right, which we'll see here in a slide, of reasons that a trade might not work. Okay. Well, now we're going to go a little bit deeper and take a look inside bars. All right. So the first thing, as just a quick review, we talked about this last week. Right, just as a quick review for those of you that weren't here last week. Before entry, clean pattern, relative strength in the market, bottoming tail or shakeout, above resistance, igniting volume, right? That's what we want to see, okay? On 3-bar plays and breakouts specifically, okay? After entry, clear price movement of at least a quarter of an hour quickly, volume spike, no immediate or sudden topping tail showing selling pressure, holds above the break-even point. So basically what we're going to do is we're going to take these concepts, before and after entry concepts, and we're going to expand upon them today. We're going to go a little bit deeper into these things, okay? So I still agree with all these things, and I think these things are absolutely relevant and required. You want a stock to hold above the break-even point for at least the first 3 to 5 minutes, okay? Be mindful of market conditions, et cetera, and so forth. Great. And what does that look like? It looks like this, right? We saw this slide last week. Wide range bar takes out the topping tails, breaks out above the consolidation, get a narrow range resting bar, rip. And what happens? When it does pull back, it pulls back after being well above break even. Break even's maybe $10.20, whatever it is, $10.25, there it is, okay? Pulls back, well, the bottom of the pullback is like $10.80. Well, that's a pretty bullish pullback, right? So again, we talked about this last week. This isn't what we're going to focus on today. But this is what a good trade looks like. Ideal trading, hence, right? This is what a bad trade looks like, right? Again, we talked about this last week. So nothing new yet. Trust me, we're getting there, okay? Peekaboo break, less than 1/4 of an hour, no volume increase, didn't stay above break even, lots of topping tails, okay? What should we do? Run, walk away, whatever, okay? So that's last week. Now let's take what we learned last week and combine it to this week. So questions to consider, all right? And this requires a level of objectivity that, I'll be frank, many of you just don't have, all right? I'm just going to be serious about it, okay? Many of you just don't have the objectivity to make this work for you. So if you lack objectivity, everything I tell you today is irrelevant to you. It's meaningless if you cannot be objective, meaning let the chart speak to you. Don't speak to it. Let it speak to you. I'll repeat it one more time. Don't talk to the chart. Let the chart talk to you. Okay? You remember it. 2 ears, 1 mouth, that kind of a thing. All right. So what does the current candle tell you about the trend or the bars? All right. What does the current candle tell you about the prior bars? Okay. So remember, we're not talking about the entry pattern here. We're assuming, we're going to make an assumption today that you're taking a decent trade. Right? That's the assumption we're going to make, that you've done your checklist and you're taking a decent trade. We're talking more about after you get in bar by bar analysis. What is happening to the trade once you've entered? Okay. So when you think about it, guys, candlesticks just provide information to us, right? Every candle tells a story. The question is that story in alignment for what we want to happen, right? Is it moving towards our goal or is it moving against our goal? Okay, so let the candlestick speak to you. So more information equals a more reliable and more objective trading, right? The more information we have on a trade or a stock, the better off we are. More information either confirms or contradicts our expectations. And this is really important, okay? You're either getting confirming signals, bottoming tails, volume spikes, or you're getting contradictory signals, topping tails, lack of volume, lack of price follow through. So you have to ask yourself, as each bar forms, am I getting confirming information or contradictory information? And it's very important you objectively look at that, okay? Because there are plenty of times you get a red bar and it doesn't necessarily contradict your expectation depending on where it happens. Okay? Just because it's red doesn't mean it's bad if you're going long. And just because it's green doesn't mean it's good. We've seen green bars with massive topping tails. That's not good. Right? So be objective. I'm going to repeat that 17 more times so you're going to hear it a lot. Okay? So this is why I tell new traders, wait 15 to 30 minutes before trading. Why? You're looking for more information. And new traders often already struggle with bar by bar analysis. So if you do it with fewer bars, it's going to be even harder, right? Let's say you want to take a 1 minute 3 bar play at 9:33. Man, that's not a lot of information. Give it more time. Wait, okay? A lot of times new traders, right? You just don't know what you don't know, which is bar by bars. So giving it more time gives you more confirmation. All right, and this is why most new traders are more successful after 10 a.m. than they are before 10 a.m. All right, patience usually pays off because it provides more reliable trades. And the only reason they're more reliable is they've given you more information. And more information either helps confirm what you were thinking or helps contradict what you were thinking. And if it contradicts it, you're like, okay, I'm not going to take that. I've seen it. I've watched it for 30 minutes. Okay, so now, what are we going to be talking about here? Wide range bars, guys. They equal momentum and volatility are increasing, right? If you have a wide range bar, that means, in this case, if we're talking about long trades, that means buying momentum, buying pressure is increasing. That means what is also increasing? Commitment. Commitment from the buyers is increasing, okay? So volatility is also increasing, That's fine if it's moving in your direction, okay? Narrow range bar equals volatility is low, momentum is likely decreasing. Now, this is not always a bad thing. Sometimes momentum slowing down is a period of rest, right? We call it a pause that refreshes, right? So let's say you're in a stock that's up 5 bars in a row. Well, a consolidation at or near the high of the day is, in fact, momentum decreasing. Volatility is decreasing. But the fact that it's consolidating at or near the high versus pulling back 50% tells you just how strong the stock is. So in many cases, yes, narrow range bars, momentum decreasing can be very negative. But depending on when and where it happens, it's also very positive, okay? So we don't want to see, generally speaking, large retracements, 60, 70, 80% retracements, okay? Potentially means what? The original strength we saw has been negated. We're talking about after entry here. So we see a stock, it has a buy setup. We see a stock, it has a breakout. We see a stock, it has a 3-bar play, and it bounces, and all of a sudden it pulls back 70%. Well, if you just broke out maybe 20%, and you pull back 70, you're minus half of an R, aren't you? That's not what we want to see, okay? So in this case, we'll look for topping tails, change of color bars, volume. Why are we looking for those things? We're looking for those things to confirm. Think about it for a second. If you see a 70% retracement and then you see maybe a little topping tail or a volume increase or a change of color bar, you can go, oh man, this isn't good. Okay? So things that we have to consider when we're looking at these bars, when we're seeing momentum increasing or momentum decreasing, take a step back. Remember we talked about multiple time frame analysis, right? Make sure you're looking at least one time frame above and below. So if you're on a 5-minute chart, look at the 15 and look at the 2-minute, at least, minimum, right? Well, what's the larger trend telling you? What's the 60-minute telling you? What's the daily telling you as you're looking at these bar by bars, as you're looking at these topping tails, as you're looking at these bottoming tails and retracements? Because what happens, guys, tell me I'm wrong here, all right? How frequently, and it's not a question of, exactly how frequency, it's a generalization. How frequently do we get into a trade, right? Say it's a 2-minute 3-bar play. It stops us out. And then you look back at, say, 2 o'clock in the afternoon, and the stock's like $5 higher, and you're sitting there going, oh my gosh, this stock did nothing wrong today. It pretty much went straight up the entire day. But for the 3 minutes we were in it, we got tagged. What am I getting at? I'm getting at the larger trend was still intact on that stock. The daily, the 60, the strength was still there. But on the micro time frame we trade it, well, we got tagged on it. Okay? So you have to consider the higher time frames and the larger trend as well. Where are these things happening? So when you take a breakout and you see a topping tail, is that topping tail happening above the breakout area or below the breakout area? Okay? Is it happening above support, below support? What is the stock doing in relation to the market? Is it stronger or weaker? Meaning, sometimes a 60 or 70% retracement is not that terrible. If the market tanks and your stock is up in R, say, and it pulls back 50, 60, 70%, but the market's getting hammered and your stock's holding above support, that could be construed as relative strength, even though it's pulled back 60%. Okay? So context is so important in trading. All right? So we're going to try to take bar by bar analysis. Don't worry, there's charts. And large context. Do you see where I'm going with this? We're taking the whole forest and we're taking the branches and the leaves. We're doing it all. We're putting it all together today. So key point though, this isn't just used for entries, right? It's always used during the trade, all right? Each bar gives us new information. Use that information to determine if the trade is more or less likely to work. And this is why I keep using the word objectivity. What do new traders do? The second they see the tiniest little red bar, they freak out. It's going to stop out. We're going to lose. The ship is sinking. Well, it's possible you might be right, but based off one little narrow range red bar, that's a bit of an overreaction. Okay? So use this information to help you trade more accurately. And that's why I said stick a fork in it, the trade is done. Because as you guys know, I'm pretty well known in here for being about 90% accurate on my stick in the fork calls. Stick a fork in it calls. Why? Because I'm reading bar by bar. What did we talk about today on SQ? Long before the trade stopped, I said, guys, this is a bad sign, right? Wide range red bar followed by a topping tail. This is a bad sign, okay? So let the bar speak to you. Don't speak for them, all right? So let's take a look. So we get in a trade, right? Lower high, lower high, lower high, green bar. We're looking to enter a trade. Now just imagine we're in an uptrend, okay? And I feel like putting the whole chart on here, it takes up too much space, all right? So imagine we're in an uptrend and you trigger it over here. Good start, right? You break above this little green line there. That's your entry right there where my cursor is, right there, okay? Red bar down here, that's the bottom. That's where your stop loss goes. So far, trading 101. Nothing special here, right? Stock triggered, stop loss down here, good. It's green bar. Now, if we look down the bottom, what about these three different scenarios? Okay, what about these scenarios? Scenario number 1 here. We have the initial trade entry that we just looked at, okay? And then we have a green bar moving higher. I would say, sweet, right? So far, the information that we're receiving, that the market is telling us, relaying back to us is A-okay. Stay the course. Stay the course. Things are good. Now, what if we jump to number 2? Notice I kind of jumbled them up on purpose. What if we get in and this happens? Well, there's 2 ways to look at this. If this is a gap down, let's say it's a daily chart gapping down, when you wake up that morning, you're not going to be feeling so hot, right? Let's say you wake up and it's a daily chart and it gaps down under a green bar. You're going to go, oh shit. And I wouldn't blame you for that, okay? Then you have a decision to make here. You have a decision to make because, well, the stop loss is right here. You're not that far from the stop loss. What are you going to save yourself? 1/4 of an R? Well, you might just want to say, you know what? I'll leave it in for the 1/4 of an R and see what happens. Well, in this case, it comes back up. So depending on how this bar finishes, you might reconfirm the strength or you might be in trouble. Why am I putting this one in here? I'm putting this in here because this is a shitty position to be in. Meaning you're kind of your hands in the cookie jar and there's not a lot you can do here. Why? Because, well, you were up, you were in the money, and you wake up and the stock gaps down. Well, because of the gap down, like, you're already down. There's not a lot of money you can save yourself by getting out of this trade. See where I'm going with this? We're going to talk about both sides of the coin. We're going to talk about situations where you can clearly say, you know what, this isn't going to work. I'm going to get out, and I'm going to get out at break even. There are other situations where your hand's so deep in the cookie jar, most of it's getting chopped off anyway. Might as well leave it for the extra 1/4 of an R. You see what I'm saying? So there's 2 sides to this. This isn't to say that just because you understand bar by bar that you're never going to stop out again. That's not the case here at all. It's just saying there are certain situations where you can mitigate your risk and mitigate the loss by looking at bar by bar. Okay? So, in this case, hands deep in the cookie jar, maybe not much you can do. Maybe it goes red, maybe it goes green, you're kind of stuck. Next case, stock kind of gaps in the middle of the bar and then moves up. All right, this isn't too bad, you're in the middle. Now you have a decision to make though, right? You gap right basically just above break even. You might decide in this situation, well, I am gapping 70% into this green bar. And if I do, that's a bad sign. That shows weakness. Now remember, we can't just take this in a vacuum. We need to take the bigger context here. We need to look at the market. Maybe the market gapped down huge. Maybe the market gapped down 2% and this stock didn't gap down that much. So you might have more confidence in holding it. But now you have choices because now you're still above break even. You could move your stop loss to break even. You could move it under this bar right here and say, you know what? If this current bar takes out yesterday's bar, then I don't really want to be in this stock anymore. And you know what? That would be a reasonable thing to think. You might save yourself 1/2 of an R, right? Then it starts to move back up. So the point I'm showing you with these slides is the decision is not always a no-brainer. I know you guys are always looking for the Holy Grail, and you're going, well, geez, after your lecture, Jared, now I have all the information. We don't always have all the information. Sometimes the information isn't that clear to us. And sometimes we're already in a tough position where there's not much we can do, and we're going to take it on the chin anyway. All right, so I want you to understand that part of this lecture too. So we're going to see how you can save money using bar by bar, but there's other times where you're like, man, hand in cookie jar, not much I can do. Okay. Now, what if, take the first scenario over here to the left, okay? What if you get that gap up, but it doesn't hold, right? So you're gapping up and you're initially excited, right? You're initially excited. Wow, yesterday the stock closed green. Today I wake up and it gaps up over yesterday's bar, over a couple days ago, the red bar over here, sweet. And then it starts to sell off, sell off, sell off, sell off, sell off. Puts you in a little bit of a quandary, doesn't it? You're kind of sitting there thinking, well, I want to give the trade room. I don't want to just be super jittery and just get out with some profit. But at the same time, anytime a stock gaps up and immediately goes red is not a good thing. But again, context, context, context. What did the market do? Okay. What kind of volume is happening on this red bar? Is it leaving a big topping tail? Is it ultimately leaving a bottoming tail? Right? So you have some decisions to make here. But if you're really nervous and jittery, you could at least raise your stop up to the previous day's low, save yourself a half of an R. Okay? Once you start looking at these, now you're in trouble. If you leave a topping tail, which is about 30 to 40%, right here on the middle slide, 30 to 40% topping tail, and the next day you start going red, I'm telling you, I would put my stop loss under this bar right here. I'm going to repeat that because many of you missed it because you're worried about the cues. All right? You're worried about shit that doesn't matter right now. All right? So topping tail, which means the stock didn't close as strong as we would have liked to have seen it close. Right? Anytime you see a big topping tail, 30, 40, 50%, you have to wonder, why did sellers come in? Why did people take profits? Okay? And then the next day, a red bar comes in and completely engulfs the green bar. This is a very, very, very tough position to be in. So you may not save yourself the entire trade, but at least you'll save half the trade or 3/4 of the trade. I would absolutely have my stop loss under this big green bar because it left a topping tail, and then the previous day it got completely engulfed by a red bar, right? So when you look at that kind of stuff, you have to ask yourself, right, what's going on here? It closes below the prior bar's low. It's a potent reversal, right? You look at that, and the only thing you can say there is this is a potent, powerful reversal, which will likely continue in that direction, especially if it's on volume. This one, even worse. Now you have a wide range green bar, closes nearer at the high of the day, and you're going, nice, that's good, I'm happy. Next day you wake up and it gaps 50 or 60% into the prior bar. I'm putting my stop loss under this bar. I'm sorry, that's it. You have a wide range green bar that closed at the high of the day. Awesome, wonderful, fantastic. Next day you get a 60% gap into that green bar. That's another potent reversal. Okay, it's a very bearish sign, extremely bearish sign. Put your stop loss under that bar. You're saving yourself some money here. 3/4 of an R probably. But this is what it takes, being objective, to look at these things. So let's take a look. Move up, pull back, move up, pull back, move up, chop around. So after this big of a move up, you might expect this stock to go sideways. And there's nothing wrong with that, right? There's nothing wrong with going sideways after a big move, okay? So you go sideways, and notice the narrow range nature of these 3 bars. To me, this is generally a bullish sign, right? This whole consolidation is pretty bullish, okay? So notice, this big red bar engulfs. That's a very bearish sign, but it holds with a bottoming tail, bounces back up, and then this happens. Puts in another bottoming tail at the prior support area. That's a positive sign. That's a bullish sign. Moves back up and retests the highs. Good. That's very bullish. Then it consolidates in a narrow range. Okay, it consolidates in a narrow range. So think about it for a second. Already a strong stock. Awesome. Retests this pivot low and passes the test, right? It puts in a bottoming tail. Buyers are reconfirmed here. Retest the previous high. I mean, all we're seeing is bullish sentiment right now. Bullish, bullish, bullish. Consolidates in a narrow range on these 3 bars. Even more bullish. Why? Buyers are stepping up even sooner. We're not retesting these previous lows right here. We're not retesting that area. We're pulling back at a much higher level. So what's the point in me going through all that? This is a solid breakout. There's really nothing wrong with this breakout. When you read the bars, bar by bar here, pull back, bounce, retest, bounce, narrow range consolidation, bullish uptrend, higher time frame uptrend. Sweet, let's take the trade. Why I went through all that? To justify taking this trade. We should have taken it. Maybe you did take it. Breaks out above the pink line. What happens? It initially goes pretty good. Has a really good initial pop. Then what happens? It leaves a topping tail that's got to be about 50%, right? Bar 1, 50% topping tail. Bar 2, red bar inside of bar 1. It's not really the reaction you were looking for after a huge topping tail. Bar 3, narrow range doji bar, sort of inside bar 2, actually sets a lower low from bar 2. What is all this telling us? It's telling me that sellers are more powerful than buyers here. And when a stock has rested as long as this stock rested before the breakout, this should not be happening. It should not be happening. You see, this red bar here didn't go and retest the high of bar number 1. Not even close. Bar number 3 did not put in a higher high in any way, shape, or form. It didn't even put in a higher low, so there's no wedge here. Some of you are going to go, well, Jared, it looks like a wedge. It's not. It puts in a lower high and a lower low. What's happening? A battle is being fought, and the buyers are losing. Topping tail proves that. Red bar proves that. Doji bar proves that. Where does that leave us? Where does that leave us? Well, this move lacks follow-through. The momentum is slowing down. Buyers are less committed. The chart is telling you something here. It's speaking to you. Whether you're listening is up to you, but the chart is telling you something. Sellers are in more control than the buyers. Guys, it's always possible this trade still works, but the likely outcome is it fails. The 80% outcome is it fails. Sure, it's possible it could still work, but more than likely it fails. Well, what happens? It failed. Wide range red bar came in. Notice the reaction at support, right? This was an impressive area right down here, right? That area right there, buyers stepped up twice previously. They tried to step up again, right? See the bottoming tail, and then they just failed, okay? Yeah, that's what all of us say. If I would have gotten out, it would have worked. Until it doesn't. And then you stay in and it doesn't work. It's a catch-22. But if you're reading this bar by bar and you're reading each one of these bars objectively, this is not at all what you want to see on a nice clean breakout. This did everything right before the breakout. And it just didn't do anything right after the breakout. Careful. Careful. Stick a fork in it. Okay? All right. Let's go to the next one. All right. So, on the bottom left here, we have what? Chop, 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 chop. Tries to break out. Crappy breakout. Big topping tail. Red bar. Total chop. I mean, this thing is slop-a-rama all the way over here. Okay? What's the reaction to the topping tail? Sell off. Finally, the stock moves out of this range. Wide range bar finally takes out this area to the left. Takes out the whole area to the left and moves above the moving average. Okay, this is a 20-period moving average. It moves above the moving average. And what happens? Topping tail. What's the reaction? Overlapping slop. But here's the difference. This topping tail didn't go significantly lower. Buyers came right back in. Sellers came in, buyers came in. So this is a little bit of a better entry above this pink line, because now you have a tug of war where the buyers are looking stronger than the sellers, because after this wide range green bar, you get a big topping tail. And the immediate thought is, oh shit. But it didn't put in a significant new low. It put in a slightly lower low. Okay. And then a green bar came in and left a little bit of a bottoming tail. Then you get a small topping tail, and then another green bar. And then it rips. Then topping tail, topping tail, topping tail. What's the sign here? Sellers, sellers, sellers. And what happens after the topping tail? You get a pullback. But notice here, when it says, what about this? All right. Topping tail, not good, right? Not good. Gets completely engulfed by a green bar. That is a very, very bullish sign, right? Because you have a topping tail here, sellers, red bar sellers, red bar sellers. Topping tail is even more bearish. Why is it more bearish? Because this stock was actually, this bar was what? Talk to me, guys. I need your participation on this one. This topping tail bar at one time used to be what? Luke is on point. It used to be green, right? So this is really bearish, like crazy bearish, because at one point in time, this was a green bar that had engulfed the previous red bar, right? But where did it close? At the low. So it tried to go up and take out this red bar. It tried to show some strength. Sellers came right back. Not only did they leave a topping tail, they end the bar. They close the bar at the lows. So you're immediately thinking, this is not good. Like really not good. I'd probably move my stop to break even at that point, right? If that's your management style where you can move your stop loss, you're not doing all or nothing. I would have moved upon seeing that bar, go to break even, okay? Now, the next bar comes in is a bit of a surprise. I would not have expected to see this green bar after such a potent red bar. And you're right, Jonathan, not on huge volume, right? But I would not have expected this green bar. But this green bar changes everything. It changes everything. Wide range green bar takes out the topping tail, takes out two red bars, not just the topping tail, but two red bars. We go a little higher, a little concerning, but not huge. Green bar takes out this bar. Resting bar, pushes higher, pulls back, pushes higher. Now, what do we get up here? We get a peekaboo breakout. This is not a trade you would take. You would absolutely not buy this topping tail. I mean, guys, you're up 1, 2, 3 bars with 1 or 2 resting bars after a huge move already. You have to take the whole move into context here. It moved from the bottom all the way up to the top. It has 2 resting bars, and some of you are going to buy that. Mistake. Chops around as soon as you get it. Overlap, overlap, slop, overlap, overlap, slop. Peekaboos up. What does it fail to do? It fails to put in a new high. What do we have? A bearish retest and failure. Slap. Sure, there's a little bit of a reaction here. Not much, though. Not much. Little bottoming tail, and then it just drops. So two concepts here. One, you're not taking this. Do not ever take that. It's too extended. Okay? And 2, the retest and failure means pullback. Okay? And you could also make one more argument. It is pulling back below the moving average here. Notice for most of this move, it stayed above the moving average. Okay? So this is how you're going to read a chart bar by bar. Now remember, you're not going to be right 100% of the time. Nobody's right 100% of the time. Even the people that say they're right 100% of the time. Okay? So you will be wrong. So you want to make sure that not only are you objectively reading the charts, that you have some statistics to back up your thought process. So what am I getting at? I'm telling you to read these charts in real time. Maybe record yourself in the middle of a trade. Read the chart in real time and maybe don't touch it. Just read the bar and go, I think this is going to happen next. Go back at the end of the day and see if you were right. If you were right, mark it down. If you were wrong, mark that down too. And then after your next 50 or 100 trades, mark down how frequently you're right versus wrong. And would it have saved you money or would it have cost you money? Okay? Yeah, that's a good point. My wife's right pretty much 100% of the time. That's why I always argue, or I always wonder, like, when wives argue with each other, how does that work, right? All right, okay. Let the chart guide you. Wide range green bar, nice, takes out this area to the left, okay? Bottoming tail, beautiful. So far, this trade looks good. We saw this last week. Looks good. What do you get? Well, peekaboo break. What follows the peekaboo break? Wide range red bar. Here's the problem with this. What can you do? Right? When you look at this, what realistically can you do here? It popped up and pulled back so quick. Not much. So it goes back to what I said. Sometimes, even when you know it's not going to work, you're going to take it on the chin because it happens so quick. So you look at this at peekaboo breaks, but it leaves a bottoming tail. But then the red bar comes and smashes it. So no, the odds of this working are very low, but it happens so quick. If you weren't staring at it and making very quick decisions, you were going to stop out anyway. So even when you understand bar by bar, there will be instances where you stop out. Okay. Now, what about this? This was a stick and a fork in it trade. All right, I blew it up so we can focus on the right-hand side. Okay, I blew this up so you guys can see it better. Wide bar, narrow bar. So you have a nice 3-bar play. Third bar doesn't put in an equal high, but it puts in an equal low. I like it. We get in over here, the green bar triggers. Uh-oh. Right, uh-oh. This would be a good time to put your stop loss under 64 bucks. Save yourself half of an R. It peekaboos below. In this case, it wasn't really a peekaboo. It did go some 20, 30 cents. You can see it here blown up. This is actually a bigger space than it looks. And then moves higher, pulls back, moves higher. So there's two things to learn here. This would be a great example of, hey, this isn't going to work. Bar by bar just told us so because this red bar completely engulfed this green bar. Maybe I move my stop to 63.95. Save yourself half of an R. It would have stopped out anyway. You can see the volume spike there, right? See the volume spike right here. I should have drew a line on it right there, okay? Get back in it potentially. Like in this case, either 84% it or get back in on the buy setup because the buy setup looks really nice. Lower highs, bottoming tails, doji bars, but the dojis are in the upper end of the range, okay? So you look at that and this is one you could have made an easy argument. That's why I said stick a fork in it. It's not going to work. These are momentum trades. And when the momentum is slapped in the face, slapped silly as soon as they break out, there's a problem with that. Let me repeat it because I don't think you got it. These are momentum trades. They're continuation trades. So when you get a green bar like this, that starts off fine, no problem. But when it immediately gets engulfed by a red bar, where's the momentum? Where's the continuation? Where are the buyers? They're nowhere to be found. It's not going to work. 9 times out of 10, it's not going to work. Okay? Let's take a look at another one. Oh, it's SQ. Oh my gosh. So, wide range bar, topping tail, bottoming tail, we get in a little bit aggressively here. We were waiting for a bit of a 2-minute 3-bar play. We didn't quite get it. It was a bit of an aggressive entry. I agree. Bottoming tail was nice, taking out most of the topping tail. So we get in and we waited, right? We waited till the topping tail got taken out, okay? Right here is the topping tail. We waited. We did. We waited for the high of the day so that not only did the bottoming tail show us or promote the fact that there's buyer strength here, confirming strength from the buyers, we also waited until the topping tail was completely taken out. What do we get? A nice, beautiful, wide-range green bar on volume, okay, green bar on volume, and immediately after the green bar on volume, we get a red bar, and then this was the big stick of fork in it bar. This was the stick of fork in it bar. The red bar, you could say, okay, this is not good, but it left a bottoming tail, and this was a wide-range green bar, so perhaps it needed some resting period. I don't like it, but perhaps it needed a resting period. So it rests, and then what happens? It goes from the bottom of the red bar, right down here, see it? It started near the bottom right there, climbs, takes out the red bar, takes out everything, puts in a new high. We're up 0.8 R. I'm up $800 on this thing. Right? And then the shit show happens. Sellers. The stock's done. What we probably should have done, put our stop loss under that area right there, under that dotted line, which was 266. Would have saved ourselves, I don't know, 3/4 of an R, 0.6 of an R. That's it. That's the bar we just talked about a few slides ago. It was green, for goodness sakes. This was a wide range green bar at one point in time. A beautiful wide range green bar. We're sitting there going, sweet, we're going to move to break even soon. As soon as it goes 1 R, we're going to move to break even. Boom, big topping tail. On, big ass volume. Look at the volume spike. It's the second highest spike of the day. Stick a fork in it. Okay? It's done. It's done. It's not going to recover from this. There's no way it's recovering from that on volume. So we're looking at the volume spike. We're looking at the topping tail. We're looking at the fact that it used to be green, but now it's red. It put in a higher high, and it couldn't hold the higher high. If you can't hold the higher high, and you leave a massive topping tail, you're done. You just don't have it. You're in the ring with Mike Tyson, and you're not ready. It's done. Now, see, here's the thing. Tell me I'm wrong. How hard is it? How hard is it to get out of a trade that's red? It's really hard, isn't it? See, it's easy to get out of a trade when there's a little bit of green, when you're right at break even. You could justify that. My ego can handle taking $50 on this or losing $5. It's just a little red. But what happens when you're minus 1/2 of an R? What kicks in? The hopium. Yeah, I know this thing's going to stop. I know it's not looking good. But I'm already down 1/2 of an R, so might as well just let the trade go anyway. Why? To lose another 1/2 of an R? Huh. That doesn't seem to make a lot of sense, does it? Now, obviously, if you're doing all or nothing, like I am, it puts you in a bit of a tough position, doesn't it? Okay? Right, I'll get out when it gets back to break even. It's not going to work. And we found that out on SQ twice today. Okay? The 84% rule re-triggered us back and then just slopped us around. This is a prime example, and I didn't know this trade was going to happen. Well, they happen every day lately. But this lecture was made yesterday. This just happened to happen today. You know what I mean? So, I'll get out when I get back up to break even. If it gets there, right? Exactly. What about this? What about this? We have wide range green bar taking out the prior pivot. Big old bottoming tail. Beautiful, right? I mean, this bar takes out the red and the green bar, takes out the prior pivot here at 196 area, moves up, leaves a nice, beautiful bottoming tail. You get in at 198.75, your stop's 197. Wow, beautiful what? Beautiful green bar. Follow through. And then red bar, topping tail, peekaboo, topping tail, stock is done. But what happens? The stock's done, man. It ain't going to work. This worked. It hit my target by, what was this one? A couple pennies? Do you guys remember this one? This happened, I think, few weeks. Oh, there it is, March 22nd. It happened a few weeks back. It literally hit my target by a couple pennies, but everything suggested it wouldn't work. And you know what? It really didn't work when you think about it. I mean, for the rest of the day, it just went lower. But wide range green bar, 60, 70, 80% engulfed by a red bar. The next bar is a topping tail bar. The next bar is a topping tail bar. The next bar was a wide range green bar, looked awesome, put in a new high, and slap topping tail. Done. Done. Your stop loss should have been break even. Should have been break even, and you would have gotten out at break even. I ended up making 2R. I got a little bit lucky. But your stop loss here should be break even under all this junk right there. Okay? All this junk right there. Peekaboos below, goes on a little higher, and then stops out. This is one of those strange ones because we were right. It ultimately failed, depending on where you got filled for entry. Because, I mean, I hit target just barely on this thing. Just barely hit target. Okay? No, it's not, though, Brent. Sometimes they're going to work. But most of the time, they're not. And we talked about that. And Adam gets it. It's just a game of percentage. That's all it is. So remember what I said. I don't know if you guys just don't listen when I speak. You sound like, you're like my 4-year-old. I said earlier, what are you going to do? You're going to record yourself taking trades, and then you're going to openly out loud say, stick a fork in it, or I think it's going to work. And you're going to go back at the end of the day, and you're going to see if you were right. And you're going to do that over the next 100 trades you take. And you're going to go back and see how frequently were you actually right. And then see where you would have been had you applied this strategy. Okay? All right. Here's another example. I put this one in because it's not always easy. Pull back, pull back, pull back, lower, high, lower, high, lower, high, little doji bar, green bar, and you're getting this signal right here. What's that signal? It's the opposite signal, isn't it? You're getting the, oh my gosh, was a red bar, turned into a huge, massive bottoming tail green bar. This shit's going to work. It's going to rip. Right? I mean, that's what that big bottoming tail suggests. And then, chop, 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 big red bar stops you out. Huh? Right? Or, if you had your stop below here, it works. But my point simply is, this is one that tricked us. Big, again, this was a wide range red bar at one point. But it left a massive topping or bottoming tail. That's a huge, huge commitment from the buyers. Confirmation of strength like no other. Huge confirmation of strength. You're like, damn, this is going to go well for me. I'm keeping my stop at the low because they've tested it 3 times and this shit's going to work. Chop, 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 stop. Thank you very much. Oh, see you later, alligator. Nothing works 100% of the time. We learned that in last week's lecture. Does that make bar by bar analysis irrelevant? Hell no. Nothing works 100% of the time. We're looking for what works most of the time. 75, 80% of the time. Okay? I know your intuition makes your ego feel good though, Modi, but the problem with intuition is we have a very high opinion of our intuition, right? You only remember the trades where you're like, yeah, I'm glad I got out of that one. But what about the 1 or 2 that you got out of and it ultimately worked, right? We forget those. So this is why you have to test and track everything. You have to test and track everything, okay? So that will do it for this week's lecture. I hope you guys learned a little bit about bar by bar analysis, understanding when you see a topping tail or a bottoming tail or an engulfing bar or volume spikes or relative strength or weakness to the market, how it can help save you money getting out of a trade for a smaller loss than you otherwise likely would have taken. It's not 100% effective. This is why you need to back test it. Again, video record yourself in a trade, say what you think is going to happen, and see if that actually happened by the end of the day. Then track that over a few months and see what happens. You're going to learn a lot by doing it anyway, right? You can't lose by doing it because you're just going to get better at reading the charts anyway. All right, so again, I hope you guys learned a little bit from that, and I hope it improves the accuracy of your trades. I'm Jared Wesley of Live Traders. We'll get back at it again next week.